Good afternoon, ladies and gentlemen, and welcome to the Munro Partners Investment Update. My name is Steve Fletcher. On behalf of the distribution team at GSFM and Munro Partners, thanks for taking the time to tune into the webinar today. As usual, I'm pleased to have with me Nick Griffin. Nick is co-founder and is the Chief Investment Officer at Munro Partners. Welcome, Nick.
Thanks for having me, Steve.
Great to have you again. Now, Nick, before I hand over to you, I'd just like to start by thanking everyone on the call for your interest and support of Munro. Today, the Australian Munro funds have in excess of $1.6 billion in assets since the launch of Munro just over 5 years ago. So on behalf of Munro and GSFM, thank you all very much. We really do appreciate your ongoing support. Now, a very brief product update. Recently, we made a fee change to the Munro Concentrated Fund. This is Munro's long-only high conviction portfolio of 20 to 40 names. The base fee of this fund was 1.1% per annum. However, we have reduced this by 40 basis points to a new base fee of just 0.7% per annum. This new fee structure now places the Munro Concentrated Fund at the very low end of the fee scale relative to global equity peers and provides access to Munro's best ideas at what we believe to be a very attractive price point for investors. Now, in addition to that, the Concentrated Fund will also be launched very soon as an ETF. This is obviously ideal for those of you who have a preference for listed investments, and it also means no more paperwork, which is great news for everyone. Now, an exciting piece of news that I'd also like to share with you today is the launch of a new fund from Munro Partners. Climate change now represents the largest position in the Munro funds today, making up between 15 to 20% of the long, short and long only portfolios. So Munro have taken the climate sleeve from the existing funds and created a dedicated strategy. The Munro Climate Change Leaders Fund aims to create a portfolio of climate winners that help enable the decarbonisation of the planet, those companies that are best positioned to champion and win from this structural change. Now, the unlisted version of this fund will be available to investors later this week. It has a minimum of $10,000 and will start to make its way onto platforms very soon. The Climate Leaders Fund is also attractively priced for an actively managed client portfolio at just 0.9% per annum, and there are no performance fees attached to this particular fund. Now, in addition to the unlisted Climate Change Leaders Fund, it will also be made available as an ETF sometime later in November, early December, which you'll hear a lot more about. So we're very excited about the new fund, and Nick will share more about the rationale for the new offering during the presentation today. So let's move on to the Munro Fund's investment update. The format for the webinar today will be a fairly short presentation, providing an update on the Munro funds, and we will then move to your questions, which you can submit in the Q&A box at the bottom of your screen. So please feel free to ask as many questions as you like, and as we move along through the presentation. So Nick, with that, how about I hand over to you? Thanks very much.
Thanks very much, Steve. And I echo Steve's sentiments. Thanks very much for everyone who's dialed in and for your ongoing support. And so the first thing I should probably mention is, you can probably see our new rebranding or our new livery here at Munro. We have taken the opportunity after 5 years to rebrand Munro and basically and to redo our website and a number of things. We've also come up with our new statement, which is invest in the journey with Munro Partners. And so before I could begin, it's probably important to remind everybody, who we are and what we're about. And I'll do this very briefly, but it is important to understand because it will set up the conversation for later. So Munro Partners is a global investment manager with a core focus on growth equity. So we set the business up to be your global growth manager. We recognised in Australia there were lots of good value managers, but not many good growth ones. There are good growth managers around the world, but not many in Australia. And so we established the business in July 2016, and we've done 16.8% per annum return in our flagship fund after all fees and expenses over the last 5 years. And so we just passed our 5-year anniversary recently. And the same process we actually ran for 10 years previously at another firm where we also did more than 15% per annum. So we actually have a 15-year track record of over 15% per annum returns in equities. And so it's important to stress that it's not a straight line. And then hence the word invest in the journey with Munro Partners. I wish it was a straight line to a 15% per annum return, but it's not. And importantly, I suppose, just to set the conversation up today and maybe to to prelude some of the questions that are coming in, someone did ask me the other day after 5 years, what was the thing that surprised you most in the last 5 years, and when you along the way to getting those over 15% per annum returns? And the funny thing is, there's lots of things surprise you along the way. It's always that way, whether Donald Trump got elected or whether there was a trade war or whether there was COVID. All those things obviously surprise you because you don't see them coming. But I suppose the thing that really surprised us is the underlying earnings growth of our companies that actually drove the 15% return. And that's how we actually do it here at Munro. And so if you've dialed in for an update on COVID or an update on our macro views, it's helpful, but it's not actually how we're going to make the money here at Munro. We make our money here with bottom-up earnings models of the companies we invest in. We need to prove that they can double their earnings on a 5-year time horizon, and hence that will double their share price on a 5-year time horizons if the stocks quite simply follow their earnings. That's what we do. We are stock pickers. And what's amazing over the last 5 years is how well these companies managed to perform through all of those things we just talked about. And so today, I know there's going to be lots of things people want to talk about, like inflation or the COVID outlook or etc. But ultimately, it is the earnings growth of these companies that have driven our performance to date, and it's the earnings growth that will drive them into the future. And I think we'll keep coming back to that the whole way we go through the presentation. Lastly, just to flag, our business has been successful. We now have $6 billion in assets under management, and a large chunk of that comes from people on this call today. So thank you very much. Just a quick business update, just to remind everybody, Munro Partners is a partnership. So we encourage everybody to become, we own and control our business, and we encourage people to become partners in this business. We set it up just with 3 of us to begin with. We now have 22 people, and we have 9 partners at Munro Partners at the moment. And congratulations to Bianca, Joanna, and Akilan who entered the partnership this year. And we sincerely hope to enter more of our staff into the partnership as we go into the future, and to continue to grow the business into the future. Last, just quick update in terms of business update, and just really to stress what Steve said. Look, obviously, we are most well known for the Munro Global Growth Fund. That is our absolute return strategy. That is the one that is gold. The design of that product is to try and achieve double-digit returns through the cycle. And that's the product I'm talking about when I refer to that 15% plus per annum returns over the last 5 years. This is the all-weather product. It's the product with downside protection. It's the product that we also have quoted on the Australian Stock Exchange under the code MAET. The second product we have is the Munro Concentrated Global Growth Fund. So that's obviously our relative return product. This one's fully invested all the way through. No downside protection, just our best ideas. Runs with a much higher volatility than the absolute return product, but ultimately should, in theory, get higher returns in the long run because we don't spend any money on downside protection. That's the one that we've just cut the fees on, and that's also the one that we hope to quote on the exchange sometime later this year in the new year. And then finally, we have the Munro Climate Fund, or the Climate Leaders Fund. And this is really something new for us. What we're attempting to do here, or what we're looking to do, is provide an offshoot of one of our AOIs, or one of our themes. Many of you would have heard us talk about climate as what we think is, as big an opportunity as the internet into the future. It makes up 18% of our core products today. And what we wanted to do was provide you with a standalone strategy of our best 15 to 25 ideas, so you can scale up that bet or scale up down that bet if you want to. It's also something that we know a lot of people care passionately about, and they want to allocate their capital to these carbon enablers. And so that is why we set up the product. But it's important to stress that this is a satellite product. It should not be considered as a core global equity fund. It's a satellite product alongside your global equity funds. We'll talk a little bit about it today, but we're hoping to show you a lot more once we have that product quoted on the stock exchange, probably later this year or maybe early next year. So that's a quick update on Munro and what's been going on. I'm just going to do one slide on how we invest. I recognize a lot of people on the call, have probably seen me go through this before, and they're probably more interested in what our current views are. So I'll just give you one slide to remind you. And please use our new and exciting website if you want to understand the investment process further. But the one slide I'm going to use is this one, just to remind everybody, coming back to what I said at the start, the reality is all of us every day are faced with, a very complicated world. And when you look at the global equity market, it's incredibly diverse. There's over 30,000 companies listed on the planet. And a whole bunch of them profess to grow their earnings. But the reality is only a very small amount can consistently over a long period of time. And so what we try to do here at Munro Partners is try to just distill the world down to this strong secular growing universe of companies. We have just 1,000 companies in our secular growing universe, and they're the ones that we think that can grow their earnings somewhat independently of the cycle. They split amongst these different areas of interest I'm showing on the right, and we're going to keep talking about these areas of interest today. People are going to ask us about them because this is where we have our edge. This is where we've identified an area of structural change, and then we've ultimately worked through that area to identify the structural winner. That structural winner will grow its earnings consistently over a long period of time, and what we're counting on is that their share price will follow that. And I suppose that's what I was saying at the start, is that's the most surprising thing over the last 5 years, is that's exactly what's happened. That's exactly what happened. The bottom-up work we did on the companies ultimately saw their earnings double, regardless of the environment, and ultimately their share prices followed their earnings. And so that's what we spend 90% of our time doing. That's how we make our money, and it's just important to remind people of that as we go through the presentation today. Okay, so that's just a quick update on that stuff. I'm going to skip around some slides here a bit because I've come with all of them for the Q&A, but let's just give a very brief market update. I understand a lot of people are looking at things like inflation and supply chain, etc. So what I thought I'd just do is give you, two, maybe 3 slides that really encapsulate our view of the equity market. And look, happy to go back to it in the Q&A if people have questions. Look, the first and most important slide I show you is this one. This is one that we show quite regularly, and so apologies if you've seen it before. But it's just a good way to think about the equity market as it sits today. And for everybody on this call, probably thinks about it this way as well, is the reality is equities are providing you with a carry versus the risk-free rate. So this just shows you the earnings yield of the S&P 500. So which is roughly the earnings growth of the S&P 500, or the earnings yield, or 1 divided by the PE, minus the US 10-year bond rate. And so what this shows you is the carry you're getting for owning equities. And today that sits at just above 3%. And that 3% carry is roughly the same as what you've got for the last 20 years. So the market is not overvalued. It's not cheap either. It can get as high as 6%, but we'd argue it's roughly fair value. But it's nowhere near where it was in 1999. And so the reality is the market is effectively pricing in the lower interest rates that have come through this period, and at the same time, its earnings grow. And so the big questions on everyone's lips is, is where are interest rates going to go, and are we in this so-called stagflationary period, and is inflation going to send rates up and send us off into a recession? And I think this is a good question to ask, and it's obviously something we think about a lot internally. But when we step back from it all, and I suppose this is a good chart that just sort of shows you this, we don't see anything in a post-COVID world that's actually that different from a pre-COVID world. What I'm showing you here is the US nominal GDP rate over the last 50 years and the US 10-year bond rate over the last 50 years. And in the purple line, we're showing you US total debt outstanding. And the simple thing that everyone on this call needs to get their head around, and obviously we have to get our head around all the time, is that interest rates have been falling for a long period of time. And the interest rates have been falling because the debt has been rising for a long period of time. And you can see these simple periods, both pre-crisis, post the GFC, and now post-COVID. And so what's essentially happening is debt is continuing to rise as we effectively solve these problems, whether it's the GFC, and now has risen aggressively again as we solve COVID. And so what that means is once there's more debt in the world, that makes it harder for interest rates to go up. Interest rates can't go up too much because ultimately the debt will tip the economy over, which then sends interest rates back down again. Put simply, here in Australia, if interest rates, say in Australia, got to 3%, I think most people would agree we'd have a housing crisis, and that would push interest rates back down again. And so you can say with a certain level of certainty, yes, there might be volatility in interest rates, but you can say with a reasonably certain level of certainty that interest rates are probably going to stay low for the foreseeable future. We think between a 1% and 3% range. Yes, there'll be movements like there has been here as we reopen the economy, or yes, there'll be movements like there was here when Donald Trump got elected, or here where we came out of the GFC, and they cause rotations in the equity market, et cetera, and they cause a lot of consternation, but they ultimately don't change this equation. The other thing I'd also say is, if you think about the things that have been thrown at long-term interest rates this year, this probably supports that view. So if I look back over the last 12 months, we've had an economy effectively close and then reopen. We've had every inflationary pressure known to man, be it oil prices, be it supply chain, be it semiconductors, be it labor shortages. Yet the US 10 to 30-year bond rate still can't get much above 2%. The 10-year is still 1.6%. And as I look forward into next year, it seems highly unlikely that the economy is going to reopen twice. It seems highly unlikely that these same effects are going to happen. And so what probably happens on a 3 to 5 year view is they ease. And as they ease, ultimately people realize that we are in this low interest rate environment. And that low interest rate environment, ultimately from our point of view, and I'll just skip some slides here, means that equities is probably the only game in town. And the reason why it's the only game in town is because every single person on this call is sitting there with cash in the bank or has some cash in the bank that's earning virtually no return. It's highly likely that it'll continue to earn not much return into the future. And so the simple way we show this and the simple way we think about it is this is the revenue growth that we think for a range of companies, not just a fund, but companies that we like. And this is their free cash flow yield on a 1 year basis, and this is their revenue growth on a 1 year basis. And so what you can see here is you've got a choice. You can effectively invest with Jerome Powell or put your money in the bank and effectively earn somewhere between a 1 and 3% rate with no growth at all. Or you can step out that curve and buy a consumer staple and get a 3.5% free cash flow yield with roughly 5% growth. Or you can step further out that curve to what we call the new staples, these companies that are structurally growing their revenue in excess of 10% per annum with great free cash flow dynamics. And they're ultimately going to be a better place for your money. They're ultimately going to accrue more value over that time because the compounding is going to work in their favor. And on top of that, if you wanted to, if you had complete confidence that this was stable, you could step further out the curve down to ServiceNow, DocuSign, Atlassian. And that's what you see people doing in the marketplace. Sometimes they go too far out and get a bit caught, and sometimes they don't, but that's what's happening. And we ultimately expect that environment to prevail with bumps along the way, and we are in one of those bumps, but ultimately we expect that environment to prevail. So that's probably a short summary of how we think about the market and where we sit today, and look, happy to take that up in the Q&A. So if you believe that, and if you agree that interest rates stay low for a reasonable amount of time, and ultimately you have to allocate your capital somewhere, from our point of view, this is exactly what you're looking for. So when we think about allocating capital, we think about these S-curves. We think about these great structural opportunities that are appearing in the world, because this is ultimately how we make our money. Everything else is just managing the bumps. I've shown this slide a lot of times, and I apologize if you've seen it before, but it is just a great reminder is this is the S-curve opportunity you're looking for. Mobile phone market in 2008 had 1.6 billion phones sold per annum. Today, it has 1.7 billion phones sold per annum. But smartphones go from a 10% share to an 80% share. Apple's revenues go from 27 billion to 250 billion. They go up 10 times. Its earnings go up 20 times, and its share price goes up 20 times. And it happens no matter what. It happens if there's inflation. It happens if there's deflation. It happens if Donald Trump gets elected. It happens if Europe goes broke. It happens if North Korea launches missiles. It happens no matter what. Earnings growth drove the stock price. This is the opportunity you should spend most of your time looking for. From our point of view, the opportunities that existed in the world pre-COVID are the same post-COVID. There are a range of big structural opportunities that have been occurring in the world, and all of them accelerated through the COVID period. E-commerce is the obvious one that I think we've all got used to in the last 2 years. You've effectively taken 20 years to go from 0 to 20%, and you accelerated 5% share of e-commerce in just 1 year. So e-commerce sales grew 25% last year instead of their normal 13% per annum. This is obviously great for Amazon. We also like HelloFresh in this space. Cloud computing, another one that we all got to know a lot better, Zoom, etc. And I apologize, and I sincerely hope this is the last Zoom we have to do before we can all meet in person. But the reality is the cloud workloads accelerated dramatically. Every single corporate you talk to today, even today, is starting to deal with work from home and how work from home will exist into the future. And even when we talk to our colleagues in the US and the UK, many of them are still not back at work, despite the fact that restrictions eased almost 6 months ago. This is very good for companies like Microsoft and particularly ServiceNow and Adobe. And so all of our cloud winners, is a great area for us for about 4 years now, and we think it continues to be a good area in the future. Internet disruption. Look, this is digital advertising or disintermediation of TV. Been around for a long time. Obviously, these companies are very well understood now. From our point of view, we've really consolidated them down to Google and Netflix. Facebook left the portfolio nearly a year ago now, and every time we try to step away from these couple of companies, we end up having a problem. So from our point of view, these are the two stalwarts that we like in this area today. And then the last area that I'd flag is digital payments. Fascinating area at the moment, with Square's purchase of Afterpay, PayPal potentially buying Pinterest. We are moving to a world where cash disappears altogether, and you are seeing companies jockeying for position here, and we just think it looks super exciting. It looks a lot like internet advertising looked a decade ago, and so from that point of view, have 4 investments there. Look, outside of those key areas, and look, I hope we get some questions on this areas today, because this is, I suppose, the newer stuff that some of it's been in the fund for a little while, but some of it is definitely getting very exciting. And these are sort of the non-technology structural growth areas that we see in the world, where we see potential big winners coming out of. And the biggest and most important ones in the middle there, which is high performance computing. High performance computing and semiconductors have been overlooked for decades now, as not as cyclical companies, but the reality is they're structural growers. They are the weapons manufacturers or the shovels in this boom. And the best way to think of them is the oil service companies or the mining service companies for the 21st century. We see a handful of companies here incredibly well positioned to benefit from the explosion of data that's coming. We've talked about ASML in the past, and you've probably heard us talk about TSMC, but we also think NVIDIA and AMD sit in this camp. And this is, as I'll show you in a second, quite a big bet in the fund as we move into 2022. Emerging consumer has been around for a while. We still like Airbus. We still like some global brands, but particularly the sports brands now. We've definitely backed away from the luxury brands with the problems we've had in China. And we expect those problems to continue. So that's why we've backed away there. And the last and obviously most exciting area, and the one that we've launched a whole fund dedicated to, is climate. Climate is, if you think about that S-curve that I showed you, and this is why the Tesla share price is where it is, the reality is you're buying Apple back in 2010, or that's what people think they're buying with Tesla. Just 4% of all cars today are electric. We are right at the start of the decarbonisation agenda. On Monday, you're going to see a plethora of headlines with countries committing to zero carbon. Even Australia's managed to do it. And from that point of view, now the rubber hits the road. How are you going to do it? Who's going to win from it? We've already seen one climate champion created. We expect there's going to be many, many more. And that's definitely something I hope we get to talk about a bit more today. Just skipping through a little bit. So the second last slide I'll show you just before I talk about performance quickly. So just to remind everybody, this is how we've positioned the fund today. And this is how we've positioned the fund. This is what we update in every monthly and every quarterly that you've seen from us over the last 5 years. What we're trying to show you is the areas of interest where we see big structural growth in the years ahead. And climate's number 1, 18% of the fund. High performance computing, number 2, 12% of the fund. Cloud computing, 12%. Innovative health, 12%. These are the areas where we see strong structural growth. On the right, we're showing you a number of potential number of holdings in the fund that we have that make up that 18%. So in this case, 18% across 9 holdings, or 12% across 3 holdings. And lastly, we're showing you an indicative position. And what we're simply saying, and what we've been simply saying now for 5 years, is if these are the areas of strong structural growth, that strong structural growth should equal strong structural earnings growth, and that earnings growth will ultimately equal share price growth. And that will guide you towards your 15% per annum returns. And the rest is just eradicating the mistakes that you are inevitably going to make along the way. And that's what we're trying to do all day, every day here at Munro Partners. Okay, so that's a quick update of who we are, how we invest, and how we are positioned today. I'm just going to give one last quick update around performance and show you where the 2 funds sit today. So this is the Munro Global Growth Fund as it was at the end of September. Important to stress, we have lowered exposure a little bit in September. We've put some of that money back to work in October. Maybe just to fill in a few of the details as to why we did get a little bit cautious. There is one particular issue out there that we don't think a lot of people are giving a lot of attention to, and it's not inflation, and it's not supply chain, and it's not China. The thing we're most worried about, the one wrinkle we have in the outlook at the moment is the Fed. We are perplexed as to why Jerome Powell has not been renominated. And some of the commentators we talk to in the US are concerned that this insider trading example, or insider trading issue that we have amongst a number of Fed members, mean a lot of them could end up changing here. We are hopeful that Jerome Powell gets renominated. We would not like to see the Democrats try and push their progressive agenda through the Fed. The Fed needs to stay independent. This is something that comes up once every 4 years. It's a bit like a US election. We're going to know the answer in the next couple of weeks, but that was the reason why we lowered exposure in September. We have put some of that money back to work here in October. And so you should see this fund is around 80% invested today. Why have we done that with the Munro Global Growth Fund? Because it is our absolute return fund. The goal of this product is not to beat the index. The goal of this product is to get you a double-digit return through the cycle, as we're showing you over here. And we have managed to achieve that over 5 years. As I also flagged, we're trying to do it with less volatility and better upside capture and better downside capture. And some of you will notice we don't compare this fund to the index, and there's a reason for that, because it is your absolute return strategy. It is your all-weather strategy. And so the reason why we have lowered exposure is really out of an abundance of caution around this one particular issue. The important thing also to flag is, it's not a straight line to the double-digit returns. The last 12 months has probably not been as strong as the 12 months previously, and probably not our strongest. It has been a bit slow. I think that's perfectly understandable. We made more than 40% in this fund calendar last year, and we're up nearly 10% this year. This year is behind the index. Obviously, last year was well in front of the index. That's reasonably understandable at this point in the cycle. As rates go up, you effectively get this push down in growth investments or this growth value lift as the economy recovers. That's essentially what's happened in the last 12 months. But if you think about it, a lot of those rate moves are actually now getting priced in. A lot of that mud's been thrown at interest rates and thrown at the 10-year bond rate, and it's still sticking there at 1.6%. And I think it's important to flag that, we are only going to reopen the world once. And as we move into next year, a lot of these reopening tailwinds will go away, and the market will go back to look for that structural earnings growth, because it's that earnings growth, as I keep saying, that will drive the stock prices. And so we do look at the last 12 months and actually just say it's actually quite frankly not a bad result, considering how much of the reopening pressures that we've seen over the last 12 months. And we look forward to the future quite strongly there. The second thing I'm just going to show just for completion is the concentrated fund. This is our long only product. So this is the product where we just stay fully invested the entire way through. Here we haven't raised cash because of this Fed issue. We've essentially stayed fully invested. And the last thing we just flag here is that is the performance of the concentrated product. There we will compare it to the index because it is a relative return product. And it's important for everybody on the call just to think about what's the most suitable product for their client. But this is a relative return product where we stay fully invested the whole way through, and the other one is absolute return. And lastly, just to flag, the climate product will be a fully invested product, so it'll be a relative return product also. So that's me. I've gone for 25 minutes, Steve. What I might do here is pause. That's a very brief update as how we see the world, where the market's positioned, how recent performance has been going, what we're worried about, what we're not worried about. And so I'll open it up to questions, and I'm armed with lots of slides here, so we'll see where we end up.
Okay, great. Well, thanks, Nick. That was a great update. We've got a number of questions coming through. The first one, central bank signaling has clearly changed recently, but perhaps touch on the different impacts of asset purchase tapering compared to outright interest rate increases.
Okay. Yeah, so from our point of view, we sort of, I understand the tapering argument and understand the rate hikes. I think I flagged it on this slide. We very much are the view that, it's not really going to make that big a difference. And what we're, I suppose, quietly happy about is to see these rate hikes being priced in. So in the last 3 months, the US has priced in 2 rate hikes by the end of 2022, sorry, and 4 rate hikes out to 2024. And so from that point of view, the market is already pricing in that interest rates are going to go up. And it's doing that without the market going down. And so we've seen taper tantrums in the past, and we've seen concerns about interest rates going up. And I think the Fed's done an incredibly good job here of essentially getting people used to the fact that rates are going to go up and they're getting priced in, yet long-term interest rates are staying steady. And I think they've done a really good job in doing that. And that's why we'd really like to see the same team stay in place and not be ousted on the back of these insider trading allegations.
Okay. So we'll move along to China. Now, Nick, you were quoted in the media recently with some comments on China, that you were minimising your exposure there because of regulatory risk. Can you let us know more on your view on China, and are there any other risks now, Evergrande, etc.?
I think the kind journalist at The Age said I dumped all our China stocks back in May, and every time I see a black Haval go past, I get a bit worried these days. So what we were trying to say was that China, we'd step to the sidelines. We don't have a particularly negative view on the Chinese economy, but we do have concerns about how our capital is being treated there. And so put simply, most people will know here that we run stop loss processes in the fund. And I'll just show you how those work quickly here. So as I said at the start, every investment that we invest in, the entire team is challenged with building a research pack that prove that mathematically the earnings of the company or the share price can double. And so what that generally means is the earnings will double and the multiple will stay the same, or the earnings will go up 60% and the company will re-rate, or the earnings will more than double and the multiple will come down. And so we do a simple quality score and we do a simple model to try and prove that the company can double within 5 years. And if it can, it ends up in the Munro Global Growth Fund, because that's the sort of idea we're after. Because the earnings do double, the share price will double. Along the way, you make mistakes, inevitably. And so this just shows you some of the mistakes. And we run a stop loss process. So any company that falls 20% from peak or from cost is subject to a review. We didn't come up with this. This came from my previous firm, and it's a very good tool. It's a very good tool because it's a reaction tool. It just helps you realize when you might have made a mistake. Chinese Alibaba, as you know, or many will know, was the biggest position in the fund in January 2020. And ultimately, when the anti-IPO got pulled, it triggered. It fell 20% from its peak, and we had to work out what to do. We decided to keep it, but we could only keep it for 30 days under our rule. And then we had to review it again and review it again. And so this trigger just kept coming up and we kept reducing the position. And then ultimately we sat down and decided that we didn't actually know where the earnings of the company were going to go because the regulatory regime was changing so quickly. And because we didn't know where the earnings were going to go, we couldn't actually set the price target. So we effectively stepped to the sidelines. That happened in March for Alibaba. It happened in May for Tencent. And then as it's gone on, we think a lot of people have ended up with the same conclusion. Look, going forward, since then, there's obviously been a calamity in the Chinese stock market. A lot of people have lost a lot of money. We would simply make the point that we're happy to miss the first 20% on the way back. We didn't lose the last 20, so we're not going to. We're perfectly happy to miss the first 20. Our view is simply that in the world that we live in, if I can't get clarity on what the earnings are going to be, I can't get my bottom-up process to work. And we can't get that clarity in China today, because quite simply, they investigate it and find and pay the fine all within 6 weeks. And at the end of it, they thank the regulator for fining them. Okay, and Facebook, you may think Facebook's got all sorts of problems, but the reality is Facebook can appeal any decision that US Congress puts on them. And so you can value that. And so from our point of view, we just came to the conclusion that the capital was better used elsewhere. We didn't understand the risks. We still don't understand the risks involved. And we didn't have the clarity that we could to build the models that we needed. And I just think that many others will come to the same conclusion. And so I suspect capital to keep leaving China over the medium term. And yeah, if you live in Melbourne and Sydney or anywhere in Australia, when the border reopens, strap in for the house prices, because if I was a Chinese person, I'd get my capital out of China as well. And that's really, really unfortunate. We really wish that hadn't happened. Our risk controls meant we managed to avoid that calamity. And for now, I can't see us going back in the short term.
Okay. Okay, so just moving along to the climate thematic, is there a risk that you're early on the climate thematic? While clearly very topical and important, does regulation and political stagnation make adoption slower, i.e. flatter S-curves, than what we have seen in the tech digital space?
Yeah, it's a good question. It's a good question. Okay, so from our point of view, the momentum around climate is undeniable, and you can see it everywhere you look. It's not just the countries setting the net zero targets that we're interested in. It's the corporates setting the net zero targets as well. And most importantly, the financial bodies that are forcing the corporates to set the net zero targets. And so the simple way to think about this is, BHP here in Australia has to produce a sustainability report. That sustainability report is audited by EY. And every year they have to update it. And every year it has to show progression to their net zero target. And investors like us and others are going to hold them to account to do that. And so what we think that means that this is an entirely self-fulfilling outcome now. It's inevitable that we at least attempt to get to net zero, because it doesn't actually just rely on government policy. It relies on technologies and it relies on market forces, and the market forces are incredibly strong here. And so from our point of view, when we look at the opportunity, we think it's going to cost roughly $30 trillion to decarbonize the planet. I've seen estimates as high as $100 trillion, and let's assume it's somewhere between 30 and $100 trillion. And I think that's about the best we can do at this point in time. The reason why we're excited about it is because we just see this money being spent, across a range of areas. It's not, you don't have to pay huge multiples for Tesla or buy QuantumScape or Ballard Power or some of these, very high multiple zero revenue companies in the US. It covers all industries. It covers renewables. It covers energy efficiency. It covers transition grids. It covers batteries. And so importantly, this new climate fund that we're launched, both James and I are the co-leads on this fund, and James has helped put this together, but he's ultimately, split that pie into these 4 subsets. And I just flag to everybody that the climate opportunity is not just, zero revenue technology companies. It's things like on the top left, utilities. And, utilities have gone from boring companies to, quite frankly, quite exciting companies, just because of the expenditure that we need to put on the grid over the next decades and the expenditure we need to put into renewable energy. And so these are some of the, not just the utilities, but the OEMs that we like in clean energy. The opportunity also splits into energy efficiency. So here, you're looking again at what most people would consider reasonably boring companies, whether they're insulation companies or electrical equipment companies or heating and ventilation and cooling companies whose business is just transformed. Train Technologies is a heating, ventilation, and cooling company, and we spoke to them the other day, and I think the one anecdote I'd leave you with that they told us is, they used to say, look, everyone used to only call us when something broke. That was our business for 50 years. If the air conditioners broke, call them, come and fix it. Now people call them because they need to replace the air conditioning facility because they need to hit their sustainability goals. It's a completely different discussion. So you've effectively transformed that industry. And down the bottom, you have clean transport, which is where obviously Tesla sits. But there's a whole supply chain behind Tesla, whether it's Infineon or Samsung SDI, or obviously the mineral companies that I'm sure a lot of people here in Australia are doing. And so all of these are exciting opportunities. And lastly, this last subset we call circular economy. These are the companies that ultimately, solve the biggest problem we're going to have in the long run, if you really think about it, is that GDP can't actually grow forever because we don't have enough resources. So either growth stops or we find another way to use the resources. And that's the circular economy. That's how do you recycle these products? How do you take them back and then use them again? And so this is probably one of the more undercovered areas. And so the thing I just say, Steve, yes, it's different to technology because it's probably not going to be winner takes most in any of these areas. But against that, it's a very broad opportunity that allows us to look at a lot of different sectors. And most of these companies trade at market multiples and in many cases below, so people are out recognizing the opportunity that's here. And I just maybe give you one more anecdote. When we bought Apple back in 2009, it traded at 15 times earnings. That's what it traded at. And it rode that S curve up and gave you 20 times your money. Now, when we invest in technology, we have to pay much, much higher multiples than that because people understand these concepts of network effects. They understand these concepts of winner takes most. It doesn't mean it's a bad place to invest, but it's harder than it was. Climate, we're right at the start of the opportunity and none of the companies are valued. Only one of them, Tesla, is valued like it's winner takes most. And the rest of them are not. And there's clearly going to be more Teslas coming along. And so that's why we like this opportunity so much.
Okay. Just on Tesla, we're getting a lot of questions coming. Can you take us through a closer look at how you value that business?
I can, but it's not in this slide deck. I'm pretty sure it's not. No, it's not. Okay, so I'm just going to speak about it because swapping slide decks is too dangerous at this point in the webinar. So the simple way to think about Tesla is to think about Apple. Okay, so and I showed this slide. Some of you remember I showed this slide nearly 2 years ago when we first invested, and unfortunately we are not invested today in the main funds. We are in the climate fund, but not in the main funds. But when we did first take an investment 2 years ago, and the simple way to think about it is, when Apple came along, it created the smartphone, and Apple ended up growing to being 5 times the size of the smartphone market. So the smartphone market's around 500 billion, and Apple's market cap is 2.3 trillion. And it did that because it was a software and hardware model. It ultimately, so you can go down to the shop and you can buy any phone you want. There's at least 12 other options there, and all of them outsource the software to Google via Android or to some other person. And so they're ultimately just hardware businesses. And that's why Apple is worth 2.3 trillion, and every other mobile phone company added together has a market cap of, you'd be lucky to get to 200 billion. So, they're more than 90% of the value of the mobile phone industry. And I know Apple does other stuff, and that's very simplistic, but that's the best way to think about it. Tesla is exactly the same, okay, in theory. Tesla is disintermediating the car market with a car and software model combined. And what's happening right now is we sold about 6 million electric cars this year, about 5.5 million. 1 million of them Teslas. So they got a 20% market share in electric vehicles. Electric vehicles, I think most people will agree, will grow to 50% of all cars sold on the road, and eventually to 100%. And so if Tesla holds that market share, once we get to 50% of cars electric, Tesla will be selling roughly 10 to 11 million cars per annum, which makes it bigger than Toyota. And so all the market's doing is looking forward into the future and saying, these guys are going to sell 10 million cars and discounting it back. Now, if you do that, you still don't actually get to the current share price. So what you've got to do next is you've then got to add the software model on top of that. And this is where I think it gets very interesting, because ultimately we know that the cars will become autonomous. We know that the other car companies who can definitely build a car that will drive as far as a Tesla goes and will perform roughly the same as a Tesla goes, but ultimately they'll never be able to solve the software problem because they're just too far behind. And when you get to autonomous driving and all the things that are going to come with that, just think about the 90% gross margin revenue streams that Apple has and that we think Tesla can have in the future. And that's how you value it. And if you put all of that in your model, and look, Kathy Wood and other people have done this, you end up at a $3.5 trillion valuation. And if you don't think that's achievable, you end up at sub 200 billion. And so what you've got to work out is then balance the probabilities versus the current share price. And that's the hard bit, because the company always seems to get in front of what's an acceptable risk reward for us. And so what we would highlight just one more time again is, of all the companies in our climate universe, only one of them is pricing in its 2030 earnings multiple, and that's Tesla. The rest of them are being priced on next year's numbers. And so I'll just show you one example I do have in the pack, but put really simply, if you just look at the wind market, you have to, install 20 times more wind turbines in the next 4 decades offshore and about 10 times more onshore. And you also know there's only 3 companies in the world that can build a wind turbine that a bank will give you financing on. It's Siemens, GE, and Vestas. Yet for Vestas, it will only trade on 15 times EBITDA or 28 times earnings, because the market's obsessed with supply chain difficulties and all these problems. And so I just pose the question, if you're prepared to price in the 2030 number for Tesla, why wouldn't you do it for Vestas? And I know Vestas doesn't have a software business, and I get that, but in concept, one of them looks mathematically a better opportunity for us today than the other.
Great, thanks, Nick. Just a question on ESG. Do you consider ESG issues as opposed to the climate strategy as part of your fundamental analysis?
Yeah, thank you. Good question. Okay, so the answer is yes. And this gives me a good opportunity to talk about some of our new hires here at Munro. So we have just hired our first responsible investment manager. His name is Mike Harut, and he starts next week. And then we've been on a fairly exhaustive search to find this individual, and we're super excited about this. We think ESG is effectively going to be your license to operate into the future. We are signatories of UNPRI, and we have been incorporating ESG into our qualitative factors now for 3 years. And this is how we do it, is we ultimately take inputs from groups like Sustainalytics and others to score companies on their ESG, and that ultimately revolves into their quality score. The quality score at Munro, for those who don't know, governs the multiple that we can pay for a company. So the higher your quality score, the higher the price target we can set for your company. Lower the quality score, the lower your price target you set for your company. So this is one of the reasons why Facebook eventually left the fund, because ultimately we couldn't pay as much for it. And you can see that derating in the marketplace. And vice versa, good operators can get higher multiples. And so what this ends up with just here is this is the split of the fund versus Sustainalytics. So our positions from ESG ratings versus the market over time. Going forward, our plan here is to provide our own tilt on this. So we don't want to just rely on outside operators. We want to build our own internal ESG team, because we just think it's A, your license to operate, but B, it's also a source of alpha generation. The reality is all the money is going to be following this into the future. Relying on a Sustainalytics, quite frankly, is like me saying, I just believe what the broker's earnings estimates are. If we'd done that for the last 20 years, we wouldn't be making very much money. And so from that point of view, your job here is to engage with the companies to help them get better, so that they come up the curve. And ultimately that will help improve their multiple and improve their license to operate in the industry, and ultimately improve the price that we can pay for them and improve the share price. And that's how ESG is going to work in the future. And so the last thing I'd just flag here just really quickly with our climate strategy, and I just will go back to it very quickly, as a sneak preview to what we'll show you in about a month's time, is our climate strategy are companies that enable the decarbonisation of the planet. So it's not going to be who are just the best ESG operators. If you want the best ESG companies in the world, you're just going to end up with a portfolio of Microsoft and software companies, because they don't make anything. No, what we're looking for is companies that enable the decarbonisation of the planet. So more than 50% of their revenues have to come from technologies or products that enable the decarbonisation of the planet. And by allocating capital to that product, you're effectively allocating capital to us to then give it to the best operators who will then help decarbonise the planet quicker. And that's the same for our ESG principles across all the funds. We are looking at this, so when you allocate capital to our funds, we will challenge the companies as to what they're doing at this ESG thing. We'll do it with our own research and ultimately allocate it to the best operators, which will help them get better. And that's how your capital can be used in an ESG framework. And I think that's the best way to think about it going forward.
Great. Another question, Nick. Do you think taxes might be the new interest rate rise? What are your thoughts on that?
Yeah, I mean, taxes is definitely something that they're obviously talking about in the US. It's important to stress that despite the both houses in power, they're really struggling to get these infrastructure bills and these tax policies through. Taxes, yes, could go up. It's usually a one-time thing, so it's a one-time event, not an ongoing event. It's not something we think about a lot. Importantly, also interest rates, to be fair, just a flag, even if interest rates do go up and cause these rotations, etc., it's important to remember that they are short-term effects. Interest rates don't change who wins and loses in the long run. They just change the price you pay for it. We are cognizant of these issues and we try to manage these issues, but we're not going to change the whole portfolio to buy a whole bunch of companies that we don't like and sell a whole bunch of companies we like just because we're worried about the interest rate outlook. That would be the wrong thing to do. We'll try and manage that volatility, but it's important to stress that taxes and interest rates don't change who wins in the long run. They just change the near-term price.
Okay. A couple of questions just around portfolio, the downside protection piece. So how much protection is in the portfolio at present, and what is your best guess regarding your need to increase this?
Yeah, so this is the net and gross exposure of the Munro Global Growth Fund over the last 5 years. And so importantly for people on the call who don't understand this product, it is a variable beta product. It does allow us to lower and raise exposure depending on the environment we're in. And so we do think of this as the all-weather product, or the one where you sleep well and we don't sleep well, I suppose is the best way to think about it. At the moment, you can see we have lowered exposure a little bit. We are, as I said, there's this one issue that we're a bit concerned about because ultimately, we all remember back in 2018 what happened when they changed the Fed president. our job here is, to use some of these tools to manage the downside. And we publish this in the quarterlies, so please hold us to account on it. And, that shows how the downside protection tools can help you in drawdowns like we saw in March. And so that's the short equity return, the put options and FX. And that's what we did in December. And so it's important to remember that every correction is different. Some of them are rotations, some of them are just markets going straight down. And so you'll get different results. At this point in time, we have one put option on the S&P 500, and we have about 10 to 15% in cash. So we are confident of the results of our companies, and we think we got a few good ones last night. We've had some good ones already this month. We think the earnings growth of these companies will grow well into next year. But we just recognize there are certain events that you need to, where you don't know what's going to happen. One of them is the Fed change, which we should know in the next few weeks. Things like the US election was a good one last year. And things like, Jackson Hole, COVID, etc. Sometimes you'll see us raise a little bit of cash or put a bit of protection on out of abundance of caution, but don't think that we've changed our medium-term view. Our medium-term view, at least at this point, is still reasonably positive.
A couple of stock questions here, Nick. Danaher was the biggest holding in the fund as at 30 September. Can you talk more about this position?
I can. Thank you for a stock question. So Danaher, this is Jeremy Gibson's idea. It's been great for us. It's powered into the top 10, and it's been a wonderful investment from Jez, and so we thank him immensely. Innovative health is a core area of growth for us. It's just a great place to find great companies where they effectively use technology to improve outcomes. And so this is just showing you pacemakers over the years. And so what happens is the product using technology becomes smaller and better, so you can charge more for it because you're keeping people out of hospital and improving health comforts. That's what we think about when we think about innovative health. Danaher is again coming back to this point around weapons manufacturers or shovels in the boom, is really focused on this. And apologies, the picture's a bit blurry, but they provide the equipment to make biologic drugs. And so I'm not a huge expert on this, but I'm going to try and explain it. Is the biologic drugs are the ones you grow as opposed to the ones you make. And so a lot of these products or a lot of these pieces of equipment are in many cases sometimes single use, or they're used with single use inserts. And they obviously have to be the highest of highest quality. Danaher bought into this business through the PAL acquisition or the Paul acquisition. And then we're very lucky to buy Cytiva off GE when GE got into trouble. And so they're now the dominant player in this space. As you can imagine, this equipment's been needed a lot through the vaccine rollout in terms of making vaccines and other drugs. And on top of that, we expect this equipment to be used much more into the future as we move into personalized medicine, oncology, et cetera, et cetera. And so that's what they are. They're effectively a play on the growth of biologics. From our point of view, this is the earnings growth of the company over time, and you can see that strong acceleration through COVID. This is the PE multiple we have to pay. We're paying 30 times for it. It's got an 85% Munro quality score. Mathematically, with what we know they've got in front of them, we'd still expect the earnings of this company to double again in the next 5 years, and that's ultimately, hopefully, going to give us another double on the share price. So it's definitely a core holding of the fund.
Okay. We're getting close to 1 o'clock, but maybe one or two more questions. Our business is backed by blockchain tech, an area of investment opportunity that you see has short to mid-term growth, or is it more long-term?
Blockchain at the moment, ultimately we see it mainly being used in the payments area. I just flag, as we move to 100% digital companies, you're going to see these fintechs move into this space a lot more. And so what we're essentially saying is the fintechs eventually move from, peer-to-peer digital consumer services into, much more cross-border payments, et cetera. And this is where you're going to see the blockchain come into play. And so from our point of view, we see the fintechs down here. This is the revenue of the top 30 fintechs. This is the revenue of the top 30 banks, ultimately disrupting the banks. And blockchain is going to help them do that. The other way to think about this, just quite simply, and please don't take this offensively if you work at a bank, but a bank is a bit like a newspaper. We sort of have 5 or 6 per country, and there's 192 countries in the world. And there's really just no reason for that to be that way. The reality is banks are set up in that regional format because you used to take your money there to deposit at the end of the day. Once we go digital, these banks will slowly get disintermediated, we think. And all these companies are trying to do is to become, these super apps that cover it all. And so PayPal moves across Merchant Acquire Me, Venmo, Honey, all these other businesses that they have to effectively, and Square's doing a very similar thing, which we also own in the fund, where they're trying to be your ultimate payment gateway for everything. And the blockchain will be an important part of that, and ultimately allow that ease of transition of cash and allow people to gravitate more to these super apps and away from their traditional banks. Because if anyone on this call, like I have done recently, goes to the bank and tries to make a transfer, it's a reasonably laborious process, and it is ripe for disruption.
Okay, great. Well, Nick, we are getting close to 1 o'clock, so I'm going to wrap it up there. But before I do you have any final comments you'd like to make?
Yeah. So the one comment I'd just make is ultimately the goal of the business is to be your global growth investor. That's what we set it up to start with. We've tried, all the way along to stay very consistent to our value, as these are the companies that we see as strong structural winners in the future, and those are the companies that will ultimately drive us to our returns. And that's the skill we provide for you. As your global growth investor, we hopefully complement the other products you have. And look, I just encourage you to use the website and use some of the material that we have available, because we do recognize it is a journey. It's not a straight line to these numbers, and ultimately, whether it's yourself or your clients, needs to come on that journey with us. And so the website's there as a tool for you to use, so that hopefully we can be your global growth investor in today and well into the future.
Well, Nick, thanks again for your time today. We really appreciate you speaking to our clients. So thanks again.
Thanks very much, Steve, and thanks very much, everyone, for dialing in.
Ladies and gentlemen, thank you for dialing in today, and I hope you found the session useful. In wrapping up, as mentioned, we've revised the fee arrangements to better suit investors in the Munro Concentrated Fund, and it will be available very soon via an ETF, as I mentioned, in the coming months. The Munro Climate Change Leaders Fund is set for launch, as I also mentioned. So if you have interest here, we'd love to talk to you more about it. We are going to need a bit of help from you getting this fund on your preferred platform. So any assistance you're able to provide with your platform provider, that would be greatly appreciated, and hopefully we can get this fund available on your platforms very, very soon. As Nick just mentioned, there's plenty of information at munropartners.com.au. You can access more information on the funds, the areas of interest in the lead up to the climate change launch, and also Munro have put together a climate white paper, which is also available on that website, on their website. So once again, look, thank you all very much for joining the call. Hopefully this is our last Zoom call, and next time we see you, it will be in person. And look, have a great day, and we look forward to seeing you soon. Thanks very much.